Well, let's take a look here at this little exercise that we have on reporting uncollectible accounts with regard to our accounts receivable. So our accounts receivable, we know anytime we make a credit sale, it is unlikely that we are going to receive 100% of that amount in the aggregate, that is. So if we look at all of our accounts receivable, we're going to collect most of them, but not all of them. So we have a couple of methods that we can use to adjust accounts receivable to the net amount, the most common of which is something we call the analysis method or the aging method, and that's what we're going to be looking at today. So it says here that Mohan Company estimates its uncollectible accounts by aging its accounts receivable and applying percentages to various aged categories of accounts. We actually have another video where we look at an actual schedule, and that you might find that helpful. This would be a little bit easier version of that. Mohan computes a total of $2,100 in estimated losses as of December 31st, 2019. Okay, so that is $2,100 in estimated losses. This is not what has actually occurred. All right. Further information: its accounts receivable has a balance, a gross amount of $98,000, and its allowance for uncollectible accounts. This is outdated terminology here. And its allowance for credit losses has an unused balance of $500 before adjustment at December 31st, 2019. Okay. So let's see here now. Looks like we might have a little bit less. Yeah, so our estimate initially was actually for $2,100, and we still have $500 of that left. So what that means is that we didn't have quite as much bad debt expense as we had anticipated. So if we started off with $2,100 as our estimate, and then we still have $500 of that left, these would be credit balances in this allowance for uncollectible accounts or credit losses, whatever terminology we want to use. The first item here, they say, what is the amount of bad debt expense that Mohan will report in 2019? Well, it'll be the difference between this $2,100 here and the $500 that we have left over. So that'll be $1,600. Okay. And then requirement B says determine the net amount of accounts receivable reported in current assets as of, at December 31st, 2019. Well, here's the thing. We have this $500 left over here. That doesn't mean that our estimate is completely bad. We've used an aging technique to figure this out. So all we really have to do to get this answer is take the gross amount, $98,000, and we're going to subtract from that our estimate of bad debt, or for the amount for allowance for uncollectible accounts at where it started. Okay, and that's going to give us $95,900. All right. So, with that said, we can make it all the way down here to Part C, and it says set up T accounts for both bad debt expense, which we have that right here, as well as for allowance for uncollectible accounts. Enter any beginning balances and effects from the information above, including your results from Part A and Part B. Okay. So I would start over here, and let's see here now. Okay, so what do we need to do here? Well, what we essentially need to do is, and I'll just tell you this because we have all of these figures in front of us. Our ending bad debt expense is going to need to be this $1,600 here. And our allowance for doubtful accounts needs to end up with a $2,100 balance. So let's see what we've got here. Notice it says that we have a $500 balance before adjustment. So that's going to be our beginning balance right here. All right. And we also know that we have to get to this $2,100 here. So let's keep that in mind. So we're not anywhere near being finished. So bad debt expense has a normal debit balance. So we're going to put that right here. And as we debit bad debt expense for $1,600, we would credit allowance for doubtful accounts or allowance for credit losses for the same $1,600. So debit to bad debt expense, and then we would need to then credit allowance for doubtful accounts or credit losses for $1,600 to get us to this $2,100. So now all we have to do is just enter that figure here, and we can just carry this down. Now, just to see, looks like we probably need to put something in here. I don't remember seeing that in the instructions, but I know this software pretty well. Okay, so we have all of our figures in here, and we can now check our work, and we got green check marks and everything. So evidently we did actually need the zeros in there. So again, we had $500 balance here, but our estimate was for $2,100. So you know, with the aging method or percentage of sales method, either one, we don't write off individual accounts. We're using the difference between our estimate and our balance, and then we adjust accordingly. All right, so that's it for this video. And again, we do have another video out where we actually have to go through and calculate the estimate of loss based upon, you know, current accounts receivable that's over 30 days and so forth. So you might check out that video as well for a little bit more detail.